Jim, it's been a very busy year, at least in the first 7 months for European high yield. How have you seen the covenant package evolving within Europe? In particular, what things may not be new but have got worse, and what new things have you been seeing?
Yeah, sure. So, and you say got worse, and I'll just say have evolved in an issuer-friendly perspective, because I think it all depends on your perspective, of course. I think that the trends have been increasing flexibility for issuers. Let's start with change of control provision, the provision which requires an issuer to make an offer to bondholders to repurchase the notes at 101% upon a sale of the business. Well, a few years back in the European market, and this is really a provision that's unique to Europe, a portable change of control provision crept into bonds, primarily sponsor bonds. And what a portable change of control provision provides is that upon a sale of a business, if a leverage test is met, the issuer is not required to make that change of control offer. So hence the name portable. The business can be sold to another buyer without making the offer. It grew up in the sponsor context, but you now see it in the corporate context, not as much. And so we've seen a prevalence of that this year. We've also seen an increasing ability to use that. And you see that in the ability to use it more than once. Traditionally, the portable change of control was a one-time use. Now it can be used multiple times. Traditionally, it was tested on the basis of gross leverage. Now, some issuers have a portable change of control that's tested on net leverage. And then I think if you look at the required leverage ratios that are required to use this, I think the trend has been they're higher than they used to be. There was traditionally, I think, a thought from the investor base that an issuer needed to delever a little bit to use this. And I think in some deals that's not really been required. Looking at some other provisions, in terms of restricted payment capacity, which of course is an important issue both to issuers and to owners who need to make restricted payments, and to bondholders who are particularly sensitive about them. I think the trend we've seen in 2014 is a continuation of the trends we've seen in 2012 and 2013, which is an increased ability for an issuer to make restricted payments, both in terms of investments. And when I say investments, what we've seen is in investment baskets, we've seen growers. So where traditionally the basket was up to a fixed dollar or euro or pound amount, now it's up to that amount or a percentage of assets. So as the issuer's asset base grows, its ability to make investments grow. Now what we've seen more recently is, and I think this is coming over from the US market, a grower on the basis for the restricted payment basket. Now that's a much different concept, because that permits dividends to be paid on the basis of an increase in assets, which is not really the same as increasing the ability to make investments, which you can see is more correlated. You can see an increased need to make investments as the business grows. What we've also seen is a continuation of the provision which allows unlimited restricted payments provided that a leverage test is met. This is also a provision which I believe is unique to Europe. It's not something that the US market sees. And it permits any restricted payment, dividends, investments, provided that the leverage test is met in an increasing number of bonds, traditionally a sponsor concept. We see it now in corporate, not as much, but you do see it. And it seems to be a provision that has become almost part of the European high-yield bond framework. On the debt side, we see an increased capacity to incur debt. And incur debt, primarily, when I say incur debt, the baskets haven't really changed, although you do see the same growers that we've seen in the investment baskets. But you've also seen an increased ability to incur pari passu secured debt for secured bonds. And where you see this is in what I'll call the contribution debt basket. In the last few years, many bonds contain a basket which permits an owner to inject capital, and that creates a debt basket on a dollar-for-dollar basis. The trend now is that you can actually secure that debt with the bond collateral on a pari passu basis. We also see...
and just on that point, that contribution debt being secured pari with the bonds is not being subject to secured leverage ratio test. So dilution of the bondholder's collateral is essentially limitless in that regard.
Exactly right. And so that's not subject to a leverage test. Most secured bonds will permit additional secured debt subject to a secured leverage test. The contribution debt basket is outside that and is not subject to that leverage test. Now, the reason I think it is accepted by the market is in order to use a contribution debt basket, that requires equity to be injected into the company, which is obviously a positive for bondholders. So since all of that contribution debt is required to have a side-by-side dollar-for-dollar equity contribution, the bond market seems to have balanced the value of the additional equity and the downside of having to share collateral and seems to have accepted that. We also see acquisition debt, and this is debt of an acquired company, but also debt incurred to acquire the company. Some bonds permit that to be secured pari passu with the bonds without meeting the leverage test.
And what about attacks on or flexibilities in non-call protection, the shortening of call periods or other features whereby the bonds can be taken out at less than make whole?
I think we've seen a increasing ability for an issuer to redeem bonds going back to really 2010 and 2011. And I think what we've seen are 10% at 103. And this is where a provision in the bond which says that in the first 3 years, an issuer can redeem up to 10% in any 12-month period at 103%. And the issuer can exercise that on multiple occasions, so could take out up to 30% of the bond using this provision. We've also seen, in addition to generally shorter non-call periods, an increase in the equity claw. The equity claw permits an issuer to take proceeds from an equity offering and use that to redeem the bonds at 100% plus the coupon. Traditionally, that was 35%. Some more recent issues have 40%. 40% is becoming more and more common. I think this increasing ability to redeem has come into bonds as bonds have come to replace credit facilities in a capital structure. And as an issuer has more and more of its debt in the form of bonds to kind of offset the ability it used to have under its secured credit facility to effectively prepay at will, I think that's part of what's driven the increasing flexibility. Now, you can't prepay a bond at will, but this gives the issuer the ability to prepay some of it at will.
And that convergence, making bonds repayable earlier and cheaper than previously, as against a loan which is repayable at any time without premium generally, that's a pretty fundamental change to the normal distinction between the two asset classes,
Sure,
isn't it?
Sure, and I think it's something that's helped issuers that traditionally were not part of the bond market. It's helped them come to the market. Now, there's obviously a cost for investors, and that's part of. So I think the economic terms have changed to reflect the increasing ability to redeem bonds. Now, there is still non-call protection. And I think if you look at take for example the 10% 103, they're rarely exercised. And so I think a lot of this, there is this optionality in there, but I think they're not used as often as people might think. The equity clause is rarely exercised.
But do the markets price those flexibilities in the trading price of the bonds? My own feeling is that when 10% at 103 first started appearing here, they didn't.
So I think, let's take the equity clause, 35% to 40%. It's hard to see that moving the needle much. The 10% at 103, I've heard at least anecdotally from underwriters that is a focus and that can have a cost, and it depends on the market. In a very good market, I think it goes right through. In a tougher market, investors may pay a little more attention and may demand a slightly more in the coupon. Going back, I just want to add one thing on the covenants, because I think it's all in your perspective. But increased flexibility in covenants is not necessarily a bad thing.
No.
Take, for example, for the debt covenant, rational issuers are trying to maximize the value of their business, and the ability to incur more debt is generally done to help the business grow, and which is good for the company, good for the shareholders, and good for the bondholders. And so the increased flexibility, well, it gets a lot of attention. It's not all bad. Now, on the restricted payments, that's a different story, right? Because the increased ability to take dividends out, well, that's clearly, there's no benefit to bondholders there.
Yes.
And that's, I view, as more of an economic term as between the issuers the owners and the bondholders. That seems to be the trend. But if you put aside the restricted payment capacity, increased flexibility is not necessarily a bad thing.
No, I mean, portable capital,
Yeah.
actually, how much does it matter?
Yeah.
It matters against the tradition of having a straight put at 101, but it doesn't necessarily matter if the business is going to continue to be run well by whoever the new owners are.
Exactly right, because the portable capital covenant can only be used if leverage doesn't increase. So in theory, why should the bondholder care? The other thing I'd say in the portable capital, there I think are very few occasions when they're actually used. When a business is sold, oftentimes the seller doesn't want the new bond because the portable capital enables the issuer to keep that in place, whereas oftentimes in a sale, for the buyer, the bond is not the right instrument and it doesn't fit in the capital structure. So what the buyer will want is to take the bond out. But portable capital doesn't let you do that. In order to do that, you need to be able to redeem the bonds. Failing that, the issuer needs to pay a costly, potentially costly, depending on where you are in the non-call period, make-call premium. And that can increase the purchase price, which decreases the sale price from a seller's perspective. So the portable capital, while it gets a lot of attention, I'm not sure it's all that merited.